The first we are going to discuss is the U.S. Treasury bills, bonds, and notes. Treasury bills, bonds, and notes are tradable fixed-income debt securities issued by the U.S. Treasury Department. Practically, they are all types of bonds. In addition, they are secured by the U.S. government, which makes them one of the safest investments on the market. Another benefit is that the investor shouldn't pay state income taxes on the interest. On the other hand, they are one of the weakest performers when it comes to profit. Almost all investors have them in their portfolio because they are safe and predictable. The major difference between the three types is their maturity. Treasury bills are short-term securities issued for a year or less. Treasury notes maturity is 2, 3, 5, and 10 years. Also, Treasury bonds are obligations with a term of 30 years. Not all government bonds are issued by the Treasury Department. Some of them are released by government agencies such as Fannie Mae, the Federal National Mortgage Association, and Ginnie Mac, the Government National Mortgage Association. These bonds offer higher yields than the U.S. Treasury bonds and also carry relatively low risk and are also very popular. On the downside, they are not exempt from state and federal income taxes. That's it for now. On our website you can find more posts and podcasts, as well as calculators and other financial tools. We would love to know your preferred bond type, so feel free to share them in the comments below. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube.